Good morning, good afternoon, good evening depending on where you're tuning in from. This is your uninterrupted daily market update narrated seamlessly for an AI voiceover, covering all the angles you need to understand why markets closed where they did today on June 30, 2025, what's fueling the momentum, where the risks lie, and what investors are watching as we move into the second half of the year. US equity markets opened today modestly higher, with the SPDR S&P 500 ETF trading around $614.91, showing a slight uptick from yesterday's close, and the SPY QQQ index hovering near $548.09, both signaling a steady comp drift higher amid record-setting valuations. Over the past weeks, we've seen US indices climb to new all-time highs, driven by a combination of easing trade tensions, dovish central bank rhetoric, resilient earnings, and ripples of AI enthusiasm. Market breadth has finally caught up with the rally. It's no longer just about the mega-cap tech stocks. Financials, industrials, utilities, and defense are now participating in the uptrend, and for the past session more S&P 500 names have been trading above their 50-day moving averages, the healthy expansion in participation. A powerful buy-the-dip mentality has taken root over the past 6 months. In early April, markets dropped about 12–19% in a short span, but savvy investors responded quickly, piling into beating down names like Tesla, Nvidia, and general index funds, and those who acted early have been handsomely rewarded by the rally since. That April correction seen by some as the dreaded storm turned out to be a shallow setback, giving markets an 89-day rally that shattered previous recovery benchmarks. Contributors to this rally are numerous, but key among them are the ongoing 90-day US-China tariff truce, new hope on the ceasefire in the Middle East, both easing supply chain volatility and calming commodity markets, and the continued excitement in artificial intelligence. AI isn't just inflating big tech multiples, it's now seen as a multi-sector productivity force that could structurally reduce inflation, which in turn could give the Federal Reserve room to pivot toward eventual rate cuts. Wharton professor Jeremy Siegel recently outlined four converging waves set to push markets higher: calm in geopolitics, falling oil and housing costs, AI productivity gains, and a potentially dovish Fed easing cycle by year's end. Meanwhile, analysts from Bank of America estimate that if the US avoids recession, equities could rally another 17% in the next year, with the S&P approaching 6,900 despite soft consumer and manufacturing sentiment. All the while, systematic quant and volatility control funds are poised to inject over $100 billion into equities in the near term, a number unlikely to be matched historically since 2004. Declining volatility is triggering higher exposures under algorithmic frameworks, though with the lingering caveat that any volatility resurgence could trigger a sharp unwind. Corporate earnings continue to serve as a persistent foundation underpinning market gains. AI builders Apple, Microsoft, Nvidia, Amazon, and Google have consistently beaten expectations, bolstered by resilient consumer spending and enterprise technology investment. Retail names like Nike and Lululemon also delivered upside surprises, reinforcing the message that consumption remains intact. Some cyclical names in energy have lagged modestly, tracking softening oil prices tied to improved geopolitical sentiment, while defense names are beginning to rally amid easing tensions. Nevertheless, despite record highs and a broadening rally, policy uncertainty, particularly tied to tariff expirations and unpredictable political moves, is weighing heavily on sentiment. Major banks including Goldman Sachs caution a sudden policy shift, or upcoming trade deadlines could be catalysts for volatility. Indeed, the impending expiration of the current tariff truce on July 9 looms large, and the next week will bring heavy labor market data such as jobs, and initial jobless claims that could dramatically shift market tone. Even now, volatility metrics remain suppressed, yet institutional depth is thin and bid-ask spreads remain wider than average, a sign of caution beneath the calm. Traders remain skittish, waiting for fresh catalysts. Looking at broader indicators, technical cycle analysts point to an intermediate low forming in early June, followed by validation via sustained closes above key exponential and simple moving averages. That pattern signaled a low-risk entry point that technical traders are continuing to follow into summer. Seasonal trends also remain favorable. Historically, strong gains in May and June often predict continued outperformance into year-end. Data shows the S&P gained 6.2% in May and 4.4% in June, while the Nasdaq surged 9.6% and 6.1% respectively. Internationally, global equities are also climbing. Europe's FTSE 100 recently surpassed 8,800, supported by dovish ECB tones and improved trade sentiment. IMSCI ETH and emerging markets returned 4.5% in May, helped by easing US-China tension. In India, the Nifty index has rallied roughly 2% this week, and analysts warn June 30 may mark a pivotal intraday inflection point that determines whether a breakout continues into early July. While fundamental data is encouraging, macroeconomic risks remain. Fixed income markets have seen 2-year Treasury yields jump near 3.9% and 10-year yields around 4.4% amid fiscal concerns and a Moody's downgrade to orange, despite Fed policy remaining steady at 4.25–4.5%. Markets may be expensive, but Morningstar recently noted that as of May 30, the overall US market was trading roughly 3% below fair value. That suggests valuations are reasonably priced, albeit leaving little margin for error. Analyst forecasts for SPY include a pullback to the mid-550s over the next month, followed by long-term upward bias towards 700 plus over the next few years. Those levels underscore the uncertainty between short-term oscillation and longer-term structural growth. As we move into July, investors are keyed into several critical drivers: the July 9 tariff expiration, incoming labor and inflation print including CPI, PCE, and as of the Magnificent Seven earnings season, font minutes and speeches, and whether geopolitical peace holds or fractures again. Investors must navigate this landscape with balanced strategies, diversifying across sectors, sizing positions to manage correlation risk, and possibly adding fixed income or alternative exposures if inflation cools further. Contrarian data signals, like undervalued sentiment and contained volatility, suggest upside potential, but complacency could be punished swiftly. All these forces align to set the stage. Markets are perched at record highs, underpinned by strong corporate earnings, broad sector participation, dovish central bank expectations, AI-driven optimism, easing trade and geopolitical tension, and algorithmic inflows. Yet policy risk, macro data surprises, valuation pressure, and geopolitical flashpoints loom as potential disruptors. It's a high-reward environment, but only for those paying attention to both the macro and micro triggers that could shift sentiment on a dime. So as we press into the second half of 2025, the mantra remains vigilant optimism. The runway may be long, but turbulence can appear without warning. Maintain diversified exposure, seize opportunities in dips, track data releases closely, and keep a steady eye on the geopolitical clock. Today's calm markets are built on fragile certainties, but those certainties are holding as long as policy stays predictable, earnings remain strong, and global tensions remain contained. Stay tuned for tomorrow's update, where we'll revisit key data points, unpack pivotal earnings, and track any new developments around trade, Fed signals, and geopolitical headlines. This is your continuous market briefing, no breaks, no sections, just smooth narrative to keep your audience informed and primed.